Okay, welcome to the January 10th edition of the Fats, Fuels, and Oils webinar. Welcome back from break, everybody. Again, sorry about the confusion last week on the webinar. I always intended to have one, and just for future reference, there won't be 2 weeks that we don't have a webinar ever, as long as I can help it anyway. And so I don't know if you can get into the webinar if it doesn't send you an email, but if there ever are 2 weeks, I think you can pretty safely assume, unless I'm really sick or something, that there is a webinar on the second week. All right, with that said, this week we're going to do, again, sort of the same thing that we did in the presentation last week a little bit. There'll be one minor change. One, it'll hopefully be substantially shorter than last week's presentation. Two, I'm going to go through the presentation, and then at the end, we'll go through the typical review of biofuel margins and credit price forecasts, and talk a little bit about that. All right, with that, let's get started. Okay, so last week, we got USDA's monthly fats and oils report, and the report wasn't really surprising. And in fact, the stocks number came in exactly on our number, which I think that's the first time that that's ever actually happened, which meant it had to be like almost exactly 500,000 or 500 million pounds above the NOPA stocks, because we generally add big round numbers to NOPA stocks to get our estimates. But it implied that domestic demand remains really strong. And this chart just shows total domestic demand, non-biofuel and biofuel combined, on a daily basis. And you can see over the last couple of years, we've moved above the 5-year average, and this year we expect to remain above the 5-year average and be relatively close to where we were last year. Now, currently, this is still based on biofuel feedstock demand that is probably lower than my forecast will be by the time we get to next week's webinar. And so that line is probably all going to move up. The peak that you see there in December is because of the seasonal pattern in biofuel production. We'll get the EPA's biofuel data, not this Thursday, but next Thursday, and we'll see what that says. But generally, we get a surge in renewable diesel and biodiesel production at the end of the year as obligated parties try to get enough RINs or generate enough RINs to meet their obligations. The report also implied, or the data in the report and our assumption about biofuel use also implied that non-biofuel use remained really strong. It was about 1.13 billion pounds. But if you look at in that non-biofuel series, remember, it's really volatile because it's a residual number. But if you look at the 2-month average, it's like the second fastest start for the first 2 months in the past 5 years. I think 1920 or 2021 was maybe a little bit faster. I guess probably 1920 based on this graph at least. And that's going to be critical going forward, because if I'm going to raise my biofuel feedstock demand forecast and non-biofuel is also going to be strong, then that doesn't really leave a lot of room for exports. And so our forecast for production, I think, is 26 some billion pounds. You have a change in year-to-year stocks that'll take a little bit of that away, and then you can see 25 billion pounds is going to go to domestic use. That leaves about 1 billion pounds or so for exports, and we get some imports to 300 to 500 million pounds. So it will be really tough to suggest that exports are going to be substantially above 1 billion pounds. Fortunately, you can see this is a chart of U.S. soybean oil export commitments based on the weekly export sales data that comes out. And you can see that we are off to the slowest start for a marketing year in forever, basically. If you look at the monthly data, we got Census Bureau data for November last week as well. And if you look at the first 2 months of the marketing year, I think it was the second slowest start in the past 50 years. And then even if you extend it back a little bit further, it sort of remains the second slowest start. So like, even if you go back into the 70s, we used to export more than 1 billion pounds of soybean oil per year. And in fact, in the past 50 years, there's only been 4 years where we haven't exported 1 billion pounds of soybean oil or more. Now, this year looks like we're going to hit that level, or maybe not quite hit that level, but we probably aren't going to exceed that level. And so in addition to the change in biofuel feedstock demand, one of the changes that I'm going to make is in my export forecast. Currently, I'm at like 1.5 billion pounds. There was a time that I thought that, okay, maybe exports could accelerate a bit. And if you look at the year that actually started slower than this year, the US ended up exporting 1.47 billion pounds of soybean oil that year. However, the spread between the US Gulf and Argentina remains pretty wide, a little bit more than 15 cents. And so, at least in the short term, it doesn't look like export demand is going to pick up. On top of that, you have the world fundamentals that are, the world seems much more supplied with soybean oil or with vegetable oils more broadly than it has the last couple of years. And so, there isn't as strong a demand pull as we had last year. And last year, I thought we probably would have been much closer to 1 billion pounds. And we ended up basically where we were in 2021. And so there was a time that I kind of thought, well, maybe we'll get a little bit of the spread between the US Gulf and Argentina will narrow because Argentine crush is kind of slowing down. And then the crop looks kind of worse every day almost. And so that will leave the US as sort of the only source outside of Brazil, but one of the only sources for soybean oil, and maybe we'll get exports to pick up. But if non-biofuel demand again is going to remain strong, and if domestic demand is going to, and then biofuel demand is going to be stronger than we are currently forecasting, it just doesn't leave enough soybean oil to export anywhere. And so I think that, again, we probably are headed to about 1 billion pounds or so for this year. And by next week, I hope to have everything done and the balance sheet all updated, and we can kind of go through that in more detail next week. Either way, the point really is that domestic demand remains really strong. And as a result of that, it doesn't look like exports are going to pick up this marketing year. Kind of switching over to canola. So one of the questions that I got several weeks ago was about canola oil yields and if we expected canola oil yields to pick up. And we got crush data from COPA for November, and as you can see, canola oil yields kind of continued to trend lower. Now, the way that, unfortunately, and I just didn't have time to change this morning, the way that my spreadsheet is set up, I kind of use an average number for the marketing year, and then use that to predict monthly canola oil production based on crush. And what happens then is, as you can kind of see in this chart, you get sort of a stable forecast for the canola oil yield. I don't really think that's going to be it, but you can also see that canola oil yields don't really move around that much now. That said, given where we were in November, it seems more likely that that average yield is probably going to come down a little bit than that it's going to go up. Currently, it's at 41.7%, and for every 0.01% change or 0.1% change that I make in my yield forecast, I lose 105,000 tons of canola oil supply, which is not a huge amount, and I'm probably not going to drop my forecast from 41.7% down to 40.5 or something like that. That would have a significant impact on production. But there is really strong demand, or at least in the first couple of months, there's been really strong demand for US for canola oil imports in the US. And in fact, the Census Bureau data showed in November that US canola oil imports were up about 100 million pounds from last year. Now, last year, of course, was impacted by the drought, but given what we've seen in soybean oil basis and the market's kind of disappointment with the EPA mandates and sort of the implied kind of reduction in demand that they suggest, you would think that the demand for canola oil, while probably still up over last year's drought impacted levels, probably wouldn't be quite as strong as it has been. It's been kind of surprisingly strong, especially since the US crop also bounced back. But it has been. Now, the question for Canadian crush, and this is a little bit different than it has been the last couple of years, is will export demand for canola seed be stronger than the demand for crush? So the last couple of years, kind of something that I've said over and over again is, if there's a change in canola supply, the way that I would balance that out on the demand side of the balance sheet is to reduce exports more than crush. I might still cut crush a little bit, but I would prefer to cut exports over crush. Now, this year, exports have gotten off to not a record start or anything, but certainly they are back to a much more typical seasonal pattern than we've seen the last couple of years, driven by Chinese demand. And so I think there is a question whether going forward, I'm going to be swapping some crush out for exports. The weekly data from COPA over the last couple of weeks has been particularly strong relative to sort of the 5-year average for the weekly change over the past couple of weeks, or the week before the holiday break and then the week after the holiday break, with crush up by an average of, I think, 14,000 tons or a little bit more than that per week, when typically it would be down by about 500 tons or something like that. And I think that there probably are a couple of reasons for that. One probably is the strength of demand from the US, and the other is probably this yield issue where in addition to demand from the US, there's strong demand for canola oil domestically in Canada, and then there are other countries that want to import canola oil. And so the crushers are probably having to crush a little bit more to meet the same amount of demand that they typically would, as you can see, relative to the 5-year average for yield last year, and this year's yields are substantially below where we typically are. And so that kind of suggests that, okay, well, maybe the early season demand for exports is going to be really strong, but then maybe export demand will slow down a little bit and crush demand will kind of remain pretty steady throughout the year and end up close to sort of that, well, above 10 million or just right around 10 million tons. But it's the most significant point there really is that this year, from that perspective, is going to be different than the last 2 years, where the demand for exports actually is something that I'm going to need to consider when I'm making changes. And this chart, although it's a little busy, kind of shows monthly crush and monthly exports, and then our forecast for monthly crush and exports this year and last year. And you can see that exports typically kind of peak in October and then start to fall off, and that's not unusual for a lot of commodities. Shortly after harvest, exports peak, and then they kind of tend to fall off. And this year, of course, exports would be stronger than they were last year because of the drought. But I think the important thing to note is that last year, Canada exported 1.27 million tons of canola seed to China. And in the first 4 months of the year, they've exported 1.28 million tons to China this year already. So the Chinese demand for seed is back, and that also contributes to kind of the world situation. China tends to be one of the large marginal players in the vegetable oil market, and its demand can tip the world balance a little bit. India obviously is the world's biggest vegetable oil importer, but China is kind of there. It's a very large vegetable oil importer, and it can have a substantial impact on world vegetable oil prices. And I always use this example, but if we go back to coming out of the early COVID lows, it was really Chinese demand for soybean oil because of a drought in Ukraine limited their access to sunflower oil. They kind of kicked off the rally that took us from 30 cents or below 30 cents up to 70 cents or 60 some cents in June of 2020. So that's kind of the impact that China can have. If China is buying canola seed and can crush canola seed, then its demand for vegetable oil is not going to be as strong as it would be if it couldn't buy the canola seed. And that's a major reason why I kind of think the world backdrop is more bearish than it has been in the last couple of years. However, just to go back to sort of the previous topic for just a second, this is the current forecast for crush and exports. But again, if export demand remains really strong and crush slows a little bit, and right now you can see kind of I've got this tick up in crush in July, and that typically doesn't necessarily happen, although it happened last year just because they started to get early. They were really low on inventory, start to get early harvest, and they can increase crush a little bit. But right now, that's because July is kind of a balancing month in my forecast, and the implied crush for January is lower than I expect it to be. And so while I'm using that number right now, because it's based on the weekly data, I expect January to come up a little bit. That'll take July down a little bit. Outside of that, though, if I need to make additional changes to crush, again, it probably is going to be because exports are stronger than expected, and I don't want to take ending stocks down that much more. If you look at the Canadian canola seed balance sheet, ending stocks are relatively tight, not historically or not record tight, but they're historically tight. So there isn't really a lot of room to move there. And of course, the crop is grown and harvested, so we're not going to get big changes in the supply. So I'm going to have to balance it on the demand side. All right, shifting to palm oil. So last night, the Malaysian Palm Oil Board released the monthly supply and demand report, when I wrote the Malaysian section of this week's report, the data hadn't come out yet, and so I'll update the next week. I'll talk about the implications of the data. Generally, the stocks number came in kind of in line with our expectations, a little bit below market expectations, but not dramatically below market expectations. And production came in sort of generally, I think, in line with market expectations as well. For Malaysia, I think going into the report, the most significant difference between my expectations and market expectations was in imports. And so I had a marketing year forecast of like 1.125 million tons of imports, which was lower than last year, but it was kind of in line but not substantially lower than last year, and kind of in line with where we've been the last couple of years. However, the first couple months of data, imports have been much weaker than that marketing year forecast would imply. And so this week, what I wrote about is the fact that, one, I'm probably going to have to cut that import number, but the import number suggested that domestic use was going to be substantially stronger than it was last year, and kind of probably maybe a little bit stronger than if you just sort of drew a straight trend line through domestic use over the last 10 years or 15 years or whatever. Maybe a little bit stronger. I was predicting a little bit stronger domestic demand than that trend line would suggest. And so if I cut imports, then that was going to imply a reduction in domestic demand, which wasn't that bad because domestic demand was probably a little bit higher anyway. And domestic demand for Malaysian palm oil is driven by Malaysian biodiesel production. And the switch in importer preferences for Malaysian palm oil, or for biodiesel made out of palm oil from Malaysia, has the potential to significantly limit Malaysian palm oil or Malaysian biodiesel exports this year. So the last couple of years, I think the Malaysian exports have been around 350,000 tons or so. You can see the 5-year average is 425,000 tons. So we already had started to work our way down. For the first several months or the first quarter of this year, the data suggests that Malaysian export probably will drop down to about 225,000, maybe 250,000 tons, unless we really get some strong demand kind of later in the year. And since that is the vast majority of domestic demand, it's just another suggestion that my reduction in imports and cut in domestic demand probably all fit together well. The other question is, how will Malaysian production develop over the next couple of months? And there was a chart that I wanted to put in here, but I forgot, or I just didn't do it. And also I'm trying to keep this relatively short, but that showed kind of Malaysian production in the typical seasonal pattern. And what we're seeing is that the decrease, the month over month changes look like they may be a little bit smaller this year than we normally see. Now, production typically peaks in October, September. This year, I think it went a little bit longer. And so we're just in the first or second month of the decline in production. And so it's a little early to tell what the shape of this year's decline will look like. But that decline will be really important because the way that I've built my production forecast suggests that the decline will be not as deep as it has been typically, which provides more supply for biodiesel production, which may or may not be needed, non-biofuel demand, which is relatively steady or grows relatively slowly in Malaysia, and then of course exports. And the biggest key to Malaysian palm oil exports is, of course, demand from the big importing countries, China and India, but also Indonesian exports. And so this chart shows our forecast for Southeast Asian palm oil exports, Malaysia plus Indonesia. You can see that despite sort of the concerns about palm oil impact on the environment in Malaysia, that palm oil demand palm oil export demand remains relatively strong and above the 5-year average, and we expect it to remain pretty strong this year. We expect 44, a little bit more than 44 million tons of shipments out of Malaysia and Indonesia. However, the majority of those shipments, 29 million tons of those shipments, come out of Indonesia. And so developments in Indonesia, particularly the moves that they're making to increase the biodiesel blend domestically, can not only have an impact on Indonesian exports, but also have an impact on Malaysian exports. I think I said Indonesian imports, I meant Indonesian exports. And so not only will the supply, domestic demand, biodiesel production in Malaysia have an impact on the exportable supplies, but the exports out of Indonesia will also have a substantial impact on how much palm oil Malaysia exports. Right now, again, we expect Indonesia to remain the dominant player, but any reduction in Indonesian exports basically translates into an increase in Malaysian exports. And so there's a very small probability that a scenario develops where changes in Indonesian domestic biofuel policy raise domestic demand enough that Indonesian exports kind of slow a bit, and Malaysian domestic demand remains relatively strong. Maybe biodiesel exports are a little bit stronger than I predict. And as a result of that, then if you get stronger export demand, you probably end up taking ending stocks down. Now, my ending stocks forecast right now is at 2 million tons, which I kind of have said is the sort of the line between bullish and bearish. And so that implies that Malaysian palm oil prices kind of tend to go sideways for a lot of the year. My forecast suggests that prices will go higher, but that's mostly a function of a narrowing of the spread between soybean oil and palm oil. And that spread has narrowed or continued to kind of, it dropped down sharply, sort of bounced back up, and then it's come back down to around 20 cents or 18 cents, depending on the contract month that you're looking at. And so if we get that scenario where Indonesian exports aren't quite as strong, Malaysian domestic demand holds up, production is maybe in line with expectations, or maybe it's a little bit below expectations, then I think you could make a case that you could trim Malaysian palm oil stocks below 2 million tons, then implying that palm oil prices should rise, narrowing that spread. Now, the chance that Malaysian palm oil stocks fall below 2 million tons is probably relatively high, but the chance that it falls substantially below 2 million tons and implies that we get a run back up to 6,000 ringgit or something, that's something that I think the probability is probably relatively small. But I think over the next month or two, as we get the production data, and then as we get a couple more months of domestic demand and biodiesel exports as a proxy for biodiesel production, we should have a fairly good grip on what's going on in Malaysia. And as Indonesia makes these changes to their biodiesel policy, we'll be able to see the impact of that on exports out of Indonesia, and we should be able to have a fairly good grasp of what's going on in the palm oil market. I would say maybe by the end of February at the earliest, but I think certainly by the time we get into March, we probably will have a pretty good lock on where we think Malaysian palm oil stocks are going to be relative to that 2 million ton level, whether they're going to be above it, significantly above it, below it, significantly below it, or right on it. All right, so I know last week in the presentation I talked about choice weight grease and said I was going to write about it, and then I ended up not having time to write the articles last week, and so this week I'm writing about choice weight grease, and so you get a little bit more choice weight grease information this week. And the first thing I think to highlight again, and it seems like I'm talking about yields for soybean oil and canola oil and choice weight grease and tallow quite a bit. And yields are one of those things that are they're something that it's really good for analysts to pay attention to, but it's not something that the average market participant probably takes a deep dive into. And so they're a little deeper than I usually like to talk about. They're probably about a level deeper than I usually like, than things I usually like to talk about. However, they are important. Last week, I kind of showed the difference in a tenth of a pound change in the U.S. soybean oil yield. You could see this week the difference in the 0.1% change in canola oil production. Well, choice weight grease is kind of going the same way, and you can see there's been a very long-term sort of trend line of lower yields. And while yields recovered in 21-22 from really low levels, they started to trend lower again. And we're predicting that 22-23 is probably going to be a little bit below where the average yield was last year. But more significantly, I think that if you just look at the yields in the first couple of months, which we have data for, there is a possibility that yields could be lower than they are now. Now, I don't think that they'll be dramatically lower. I would be surprised if the average yield came in below 10.5, say. But I do think that the risk for choice weight grease yields is to the downside. And that's important because we are currently forecasting that basically choice weight grease production is going to be unchanged year over year. And of course, we've got potentially all of this biofuel feedstock demand coming, and choice weight grease also has relatively strong non-biofuel demand. And so any reduction in production is going to suggest that one of those two industries, or the biofuel industry or non-biofuel industries, are probably going to have to taper their demand a little bit. Given what we've seen in biofuel demand, it probably is more likely that we get a trim in feedstock demand than we do in non-biofuel. However, the first couple months of non-biofuel demand suggest that non-biofuel demand is slowing a little bit, and from relative to last year, not necessarily relative to where we've been over the last 10 years. Now, our estimate, and this is just an estimate based on conversations that we've had and kind of how we think the non-biofuel demand fits together for choice weight grease. Our estimate is that about almost 80% of the non-biofuel demand goes to the feed industry. That might be a little bit high, but that's kind of the way that we've broken it down. And one of the trends that I think seems to be developing, despite the fact that we've had really, really strong soybean meal demand is that the cycles that have lined up to raise soybean meal demand to the record levels that we've seen might slowly be starting to turn. I think we certainly are starting to turn the cattle cycle. It seems like we probably are doing the same with the hog herd. Our expectation for slaughter this year is essentially unchanged, or I think maybe a little bit lower than we saw last year. The one area that's not true is in poultry, because the industry kind of is still recovering from the historic bird flu last year. And that's important because, well, it's important for meal because broilers eat a huge portion of U.S. soybean, of total U.S. soybean meal domestic use. But if that's true, then the decline that we see in non-biofuel use here in choice white grease may be just kind of reflective of that little slowdown in demand. The other thing is that a lot of fats and greases are used in the oleochemical industries, and given concerns about inflation, one of the things that is a relatively good early indicator of economic activity is the demand for vegetable oils and fats and greases, because they're so ubiquitous. I mean, they are just used in absolutely everything. And so if we do see a slowdown in demand, it may be not so much that feed demand has slowed, it may be that we're slowing down on the oleochemical side because the economy is slowing. All right, last chart. So I spent most of yesterday trying to figure out the RIN bank and the RIN balance sheet. And if you ever want a headache, try to do that. The EPA does not make it easy to figure out what the RIN bank is. And so I have some estimates. I want to refine them a little bit more, and then we'll talk about them more next week. But based on the data that we have, which seems complete through 2019, I think there might still be one little piece of data that I might be missing for 2019. But based on the EPA's announced RIN bank, I think the last one that I had was in 2017. And then just adding the implied changes in the RIN bank from year to year between for 2018 and 2019, it looks like the RIN bank probably bottomed at the end of 2019 at 1.84 billion RINs. That lines up with sort of anecdotal reports. There was a story from somebody that was a relatively large RIN trader in 2020, and they were concerned during the sort of the height of the pandemic that we could essentially run out of RINs in 2020. You can see RIN generation dropped pretty substantially in 2020, but it looks to me like we probably actually built RINs in 2020. And have in 2021 and in May and 2022 again. This question is really, really important because I think the big question coming out of the mandates is whether the mandates are going to govern U.S. biofuel production, or capacity utilization essentially is going to govern U.S. biofuel production. And one of the things that I think we need to know in order to understand which one of those is going to drive production and feedstock demand and prices is the RIN bank. Now, historically, the industry as a whole has carried about a little bit more than 2 billion RINs. Obviously, if the bottom was at 1.84 billion, before that, the bank wasn't hugely higher, but it was in the 2 billion RIN level sort of carried forward from year to year. Right now, it looks like there probably, from the 19 bottom, there probably has been at least a steady increase in the RIN bank over the last 2 years, and potentially a pretty significant increase in the RIN bank over the last 2 years. And again, hopefully next week I will have this done to a level where I feel really confident to show you what I think the RIN bank is and explain why I think that's where the RIN bank is. However, even if we built RINs up over the last 2 years, it still doesn't necessarily take us up to sort of the upper end of the historic range of the RIN bank. And if the industry is comfortable sort of carrying 2 billion RINs or 2.5 billion RINs or 2.7 billion RINs, then I think it's probably comfortable carrying 3 billion RINs. Now, that's a lot of money to carry on balance sheets just because. But what it does demonstrate emphatically is that the industry doesn't produce just to meet the mandates. And so I continue to lean more and more on the idea that given where margins are right now and the expansion in renewable diesel capacity that we have, and the recent movement in RIN prices, which we'll talk about more in when we go through the margin area, that we probably are going to produce more biofuel, more biomass-based diesel in 2023 than the mandates would suggest. And that is what's driving this whole exercise in trying to redo my forecast and come up with a feedstock demand number that is more driven by sort of capacity utilization than it is by what the mandates imply. I think the market is starting to realize that, although I've talked to quite a few people that have pushed back relatively strongly on that idea. We'll see, and again, I think what's happening in RIN prices, and I put a chart of the 2023 vintage D4 and D6 RIN prices up in the articles this week to sort of show this. I think the market is concerned about the ethanol blend wall, and so that's keeping RIN prices elevated, even though the HOBO spread has fallen and feedstock prices have kind of fallen. And so that also suggests that the market isn't worried about sort of the lower mandate, or producers aren't necessarily worried about the lower mandate. And I think gives another point that suggests that we may produce more than the mandates imply this year, leading to, again, greater feedstock demand. All right, so that is it for the presentation. I also want to go through the forecast stuff really quickly, if I can find it here. Bear with me 1 second. Okay. So here's the chart of D4 and D6 RIN prices, and you can see the spread between the two dropped to like $1 something in early January. Now it's come back out to about $3, but that's significantly more narrow than we're projecting for the rest of the year, and more narrow than any time for the 22 vintage RINs. They never traded within sort of 3 cents of each other. And that is really a function of the concern about the ethanol blend wall. While the vast majority of the time, RIN prices are driven by feedstock costs, when the market is concerned about the ethanol blend wall, that is what drives RIN prices, because the RIN market needs to encourage more production in order to fulfill the total mandates. And I think that's what's going on right now. Now, of course, based on what I just said, if the mandates are, if the industry is going to produce based on capacity utilization and margins remain historically high, then we should overproduce relative to the mandates. We should have more RINs than we need, and it should drive RIN prices substantially lower. The other possibility is that when I go through and finally really get the RIN bank balanced and settled, that I'm going to find that the RIN bank is significantly smaller than I thought. And so even if we have an excess of, let's just say, a billion RINs, that the industry is still nervous about that, the ethanol blend wall, and you get this action in RIN prices. And as you'll see in a minute, it's impacting our forecast for RIN prices going forward. What's going on right now is kind of driving our forecast going forward. However, I do think that there is, if the thesis that capacity utilization is going to drive the production, if that is correct, then at some point RIN prices are going to have to break. So if we're really going to, if we've got 2.5 billion RINs in the RIN bank, and then we're going to overproduce relative to the 2023 mandates, that suggests that the RIN price will have to break at some point, because we should have plenty of RINs to meet the obligations. However, that's not what the market is saying today, and I think it kind of backs up this idea that while the mandates were disappointing, that's not necessarily where we're going to end up in terms of production. All right, I kind of will try and quickly move on to margins because this hasn't worked out to be shorter so far. Margins kind of have continued in the same sort of trend that we saw before the break, with biodiesel margins over $1 and renewable diesel margins sort of slowly working lower. We expect both to kind of work lower throughout the year. But a lot of that will, of course, depend on what happens with feedstock prices and energy prices and RIN prices. If RIN prices are going to break substantially at some point, that would imply that significantly lower profitability, probably at least initially for biodiesel producers and then renewable diesel producers. However, if the margins don't change and RIN prices remain relatively strong, at some point, I think the renewable diesel margins are going to have to fall to a level that starts to put pressure on biodiesel margins. Now, based on our estimates, obviously we are a long ways away from that, as we are way up here, which is, well above where we were in the depths of COVID. But even if you look back over sort of the longer term average, we're still way above where we have been historically. And so there's a long ways to go. And that may imply that that renewable diesel margins really need to move substantially lower before we start to drive out biodiesel capacity. Trying to figure all of that out is what I'm focused on right now entirely, because I think that not only is going to be really significant for all of the renewable diesel and biodiesel producers, but I think it's going to be probably the most important thing to know and to have an idea about for 2023 in terms of trying to forecast feedstock prices. Is trying to figure this out and really trying to figure out where feedstock demand is going to be. All right, if we look at our RIN forecast, you can see I've got the spread widening out. That's primarily because I tend to go back to what I think the average is going to be, or what we've seen historically. But the really narrow spread right now could carry on for a while yet. And if it does, then probably both of these forecasts will end up going higher. Now, when I ran the model this week, it came up with prices that were pretty much in line with my expectation and where the market looks like it's going. So I didn't make a lot of changes, but it does have this big gap between the D4 and the D6, and I'm not sure that that is going to that's going to happen here in 2023. If we just look at, I just want to look at this kind of quickly. We usually don't look at this, and this chart is a little not super straightforward, but this is the forward curve for the HOBO spread. And so this is where we were last month, and then last week, and then this week. And so you can see the HOBO spread is coming down pretty aggressively, and that implies greater profitability for biofuel production, which again should drive RIN prices lower. I guess if I go back and actually look at this RIN price history, we have moved down from the peak in November, and so that does kind of fit. But I do think that the narrow spread generally suggests that RIN prices are going to move higher. It may ultimately be that the HOBO spread and feedstock costs really do drive RIN prices, even when there's concerns about the ethanol blend wall. But historically, I think that when you've seen concerns about the ethanol blend wall, you've tended to have higher RIN prices. And this will probably be the year that I'm proven entirely wrong on that. All right, the last one, LCFS credit price, that is really kind of steady Eddie. We have really, I think, found the bottom around this 65, 67, 68 level. And so we kind of have a slow increase from here. But a lot of what will happen will depend on any changes that CARB makes to the program. Okay, so there are a couple of questions. What is the driver for your strong 2023 tallow price forecast? Why such a divergence from 2023 SBO? The strength in tallow really comes from sort of a combination of three things. So in one, tallow seems to be probably the most preferred fat in Greece, and so as a result of that, we've had a big increase in tallow imports over the last year or so. And at some point I talked about it last year, where we have a model that predicts US tallow imports based on tallow production around the world. And that model worked really well for several years, and it broke last year because imports were just so much stronger than the model was predicting. And so to get that, to draw those imports into the US, you probably have to break the traditional relationship between things like tallow and soybean oil, and kind of raise prices. Now, if the strength of that price then makes tallow less profitable for biofuel producers and less popular as a biofuel feedstock, then I may end up having to come back and readjust that. But I think that at least what we've seen over the last couple of years, and certainly again over the last year, is that the strength and demand from the biofuel industry is really driving tallow demand up and above US production. Now, like I said, I kind of think that we are close to a turn in the cattle cycle. And if you look at the expected production kind of going forward, the cattle cycles generally tend to turn kind of slowly. So going forward, we probably are maybe a little pessimistic on production, and maybe the cattle cycle turn won't be that won't be what we expect it to be. And in that case, I probably would lower prices, but based on that fact and the strength of the demand and the idea that we really do need to draw imports, and we need to draw more imports this year than we did last year, and we're going to need to draw more imports next year than we do this year. I think that the relationship between tallow and soybean oil probably is going to move to a new level. We've seen all of the fats and greases kind of move from the long-term relationship to soybean oil or to other fats and greases over the past year or two. But I think there probably is some further refinement, particularly for tallow, just because it has been, again, the most popular fat and grease in biofuel use. What is the date at which point LCFS will decide to, yes, no, discourage the use of virgin oil feedstocks as a feedstock for renewable fuel? So the last conversation that I had with somebody at CARB suggested that sorry, let me back up a little bit. The original plan was they held some meetings over the summer and in the fall, and they kind of outlined some of the changes that they could potentially make to the program. And one of those included kind of a European style cap on lipid-based biofuels, lipid-derived biofuels, I guess. And after those meetings, I called somebody that I know at CARB, and I was kind of talking to them about the changes and what he thought the probability was for each of the kind of changes. Like, they can do that. They can also cut the carbon reduction targets, and there are some other changes that they could make to try to lift the LCFS credit price. And I asked him about the timeline. And so I think the decision, if I'm remembering this correctly, I think the decision comes sometime in 2023. And I don't remember exactly when that was. And I will, if you send me an email, I will follow up with you on the schedule for that decision. However, whenever that decision is made, his other point was that he didn't believe that CARB would be able to implement the changes until the beginning of 2024. And so our LCFS credit price forecast kind of reflects the idea that the earliest that CARB can make substantial changes to its program and raise its credit price is 2024. Now, the thing that I think there, and I kind of have gone back and forth on this, but I think I've finally settled on really how I think about this, is that if CARB does make some changes, unless they really do put a very hard and very low cap on lipid-derived or vegetable oil-derived biofuels, then I think that any increase in the LCFS price is probably just going to attract more biofuel shipped into California. And as a result of that, then you would drive the price back down. I think the equilibrium price for LCFS credits is probably the marginal cost of shipping for the entire biofuel industry, particularly the renewable diesel producers, into California, and that seems to be around $65 or so. If CARB makes a change that raises the LCFS credit price, but doesn't limit the use of vegetable oils, well, you can imagine we ship like 75% of domestic renewable diesel production into California. We only ship like 10 to 15% of domestic biodiesel production into California. So if they don't put that limit on, you can imagine that renewable diesel producers and biodiesel producers will take advantage of will capitalize on the higher credit prices by shipping more fuel into the California market as long as it's profitable for them. If they do put that kind of a cap on there, then I think that it will be very effective in raising the LCFS credit price. But I don't know that it will be as effective in sort of reaching the goals. So 40% or 45% of renewable diesel uses soybean oil. More than 50% of like 55% maybe of biodiesel uses soybean oil. You add canola oil on top of that. And if you really cut into that supply, you're not going to have as much renewable fuel as you probably want in California. It may be that the cap comes in a year or two, as opposed to in 2024. Maybe it comes a year or two later than that, which allows the electric cars and trucks to kind of catch up a little bit more and maybe reduce the demand for biodiesel and renewable diesel, so that when they implement the cap, demand isn't as strong, and the resulting decline in supply doesn't send biofuel prices in the California market up through the roof. But I think no matter what happens with all of that, I think the earliest that you can anticipate that there will be changes actually implemented to the LCFS program is in 2024. Like I said, I will reach back out to CARB and I will follow up with you and let you know when they're going to make the decision. And excuse me, I'm just writing down his email address. All right. Thank you, everybody, for your attendance this week and your support. There's one last thing that I wanted to mention this week, and that is that, and I probably should mention this at the beginning, and I will start to mention this at the beginning. One of our customer success people suggested to me that, hey, you have all of this data and there really isn't a way to download it. And unfortunately, right now, we're stuck in this sort of purgatory where we can't really make changes to the old Jacobson website, and we're going to a new platform. And so everything is kind of frozen from that perspective. But what I do want people to know is that I forecast all kinds of things beyond what you see on the website. And if you are interested in getting access to that data, if you have a data request, if you would like to know, hey, even what's the historical monthly shipment of soybean oil for the US or anything like that, you can't necessarily download it from the website, but you can send me an email, and generally I'm really happy to send you whatever data you want. Obviously, there will be some data that I can't share. Depending on the request, there may be some data that I need to charge for. But I'm going to start reminding people that they can access that data. They just have to kind of send me an email until we get onto the new platform, and then hopefully everything will be available and you'll just be able to download it. The other thing that I wanted to say, this is actually the last thing. The other thing that I wanted to say is that I'm going to be at the Clean Fuels Conference in Tampa at the end of this month. And I'll say this again next week. So one, unfortunately, that conference starts on a Tuesday. So not next week, but the week after that, we won't have a webinar. But also, if you are going to the Clean Fuels Conference in Tampa, please let me know, and I would love to see you there and sit down and grab a cup of coffee. I don't drink coffee, but if you drink coffee, you can drink coffee. But I would love to see and talk to anybody that is going to be at the Clean Fuels Conference in Tampa at the end of this month. And again, I'll say all this next week. All right. Thank you so much, everybody. Sorry, the presentation thing still isn't quite short enough. I'm working on it. I really want to get it down to 30 minutes so that I'm not doing this like this every week. So I'm going to keep trying. I appreciate it. Hope everybody has a great week, and I will see you next week.